All right, perfect. So thank you for joining us for the webinar version of our forecast. Josh presented the physical event that was at the end of January, and although some of the information is going to be very similar, there's going to be different takes and a couple of additional things that I may have been able to find out since the last month when Josh presented. So hopefully there'll be a little bit of a additional flavor on top of what Josh presented, which just basically means that there was more information now than there was a month ago that we're able to look back on. So the first slide that I'm going to pull up here for you guys to see is going to be the disclosures and kind of requirements that the lawyers make us provide. So I'll give you guys a second to read through that. All right, so if there's anything intriguing there that requires a follow-up question, feel free to shoot questions over through the question comment box throughout the presentation. I'll make sure that I address those by the end of the presentation. So today we're going to get started with where we've been. We'll then go to where we are currently and how we're seeing things. And then the final step would be where we may be going. So all of those things are very valid to kind of visit for their own purposes, because obviously the market is very dynamic. Things don't just occur because of what's going on today. They're a reflection of what has happened in the past and what people forecast to be coming in the future. So that's why we always like to visit all three of these areas. So where we've been, if you remember from 2016, and obviously the first half of 2016 seems like it was so long ago now, but there's been a variety of things that happened over 2016. And really one of the common threads going throughout the year was to begin expecting the unexpected. So Trump, I know now our current president, no one really believed that he had a really solid chance at becoming our president. So there was definitely people that were hopeful that that could be the case, but I think a lot of people just thought it was something that was going to fade out, and eventually he would end up being exposed if he wasn't able to handle the limelight from that presidency standpoint, being a presidential candidate. But he did have a strong showing and ended up winning, so that was surprising throughout the year. And the other thing was that the Pokemon Go hit app, so you guys probably saw people over the course of the summer when it rolled out. There was a lot of people staring at their phones more than normal, walking around, so that was something that was a huge hit. It caused Nintendo's shares to kind of skyrocket temporarily until they realized that Nintendo didn't actually own the rights or have any really revenue share that would have been substantial from that, so then that ended up falling very quickly. We had the famous star from Harry Potter end up passing away unexpectedly, as well as Prince. And so those are some of the things. One that was really market related in addition to the Trump being elected president was the Brexit that occurred over the summer. So that was really unexpected as well. So we can talk through that a little bit more as we move on. So as was the case throughout 2016, a lot of unexpected things were occurring, and the pollsters who kind of take the pulse of different things that could be arising in the future, whether it was elections and things like that, they tended to be a lot more wrong than they had been in the past. And so one of these goofy things that ended up occurring here is that for the Italians, there actually is a law against how they are able to present polls. So 15 days before any election of any type, the pollsters are not allowed to present any types of polls or any information that they gathered. So what they ended up doing is creating fake polls and kind of tying them loosely into some of those real life election situations. And so you can see that they started getting a little bit fancy to work around that law against kind of prohibiting polls over those 15-day time periods before elections. So before we dive in too deep, we're going to do a couple of fun brain exercises. And so we just kind of reviewed how previous pundits and pollsters had been incorrect pretty often over the course of 2016, but being us as being consumers, in a non-scientific way, we're going to go ahead and poll each and every one of you guys who are watching today, and we'll kind of review and see who you think that this advertisement is for. So as consumers, what would you think that this one displaying here, so we have some goldfish in a bag and a porcupine in between them, who do you think this is promoting? What type of product? So if I can have a few questions, I'll give you guys a moment to enter that in, and you can just enter that in the questions box. So as you guys are trying to think and guess at that is, I'm going to give you one additional hint. So for this, a lot of people who drive are going to appreciate this type of service. And so Rick asked if it's a plastic bag, and not quite, although that would be a good guess. This is actually for parallel parking. So obviously with the porcupine needles, he has to have some precision there, or he's going to end up hurting some of his friends. And so that's kind of the description of what this advertisement was for. All right, so now that you kind of know the direction we're going with this, we'll go to the next one. So look at this one. What do you think that this particular image is promoting? Give you guys a couple of seconds to kind of throw in your questions there. And so for this, I'll give you a hint. It has to do with having a headache or some type of pain. So this is an advertisement for pain pills. All right, so those other ones definitely, I think once I told you, made a lot more sense. This one's a little bit trickier. What would you think that this kiwi with the seeds removed from that would be for? So yeah, I see Doug answered seedless kiwis, which, yeah, that would make sense, but this definitely takes a little bit more thinking than even some of those other ones. Any other guesses before I reveal that? All right, Doug, you're getting a little bit carried away here. So actually, what this what this is for is actually for dental floss. So definitely a little bit outside of what you would expect just looking at the seedless kiwi there. All right, and so look at this one. This looks like it's the bottom of a shoe. What would you guess that this guy would be? Yep, so we have an answer of map and apps, which definitely is pretty popular these days. That is not the correct answer at this point for this guy. And so that the correct answer for this is going to be topical anti-inflammatory spray. So, yep, definitely people are getting a lot more creative when it comes to advertisements. So this one, I think, is the most obvious one. What do you think that this advertisement's for? I think anyone can guess the company pretty quickly on this. But what type of service offering do you think this is promoting? Yep, so it's definitely has those Wi-Fi symbols, and those fries look eerily similar to a popular fast food joint. So that was the only one that we got correct. So that was great there. So again, we're going to be looking back at what occurred in 2016, and I don't know how many of you guys remember, but this time last year there was still a lot of panic going on as far as the markets were concerned. So the year started out the end of 2015. The Fed actually raised interest rates for the first time in a very long time, and it didn't seem to affect markets those first couple weeks. But as soon as the new year started, if you kind of look here on the left side, you can see that the market just started falling pretty quickly, and a lot of that had to do with the oil at the time. And then you can see kind of this number 2 area where that Dow Jones Industrial Average hit the low for the year, and that it actually hit a low for since 2014 at that point. So the markets fell fairly quickly at the beginning of the year. Basically at that point though, it did start rallying back. So this is probably what most of you guys remember, is last year was a pretty solid year, and you can kind of see the different variations and the different events that could have caused various things to bounce around a little bit more. So there was 3 obvious points. The oil hitting a 12-year low and kind of causing that 2-year low for the Dow Jones Industrial Average. But then also in the summertime, June 23rd was when the Brexit vote came in, and the Britons voted to leave the European Union, and that shocked the market for a whole 2 days basically. So there was a huge dip overnight, and it lasted for about 2 days, but then you can see very quickly that rebounded. The reason why the market reacted as it did is because it was very surprising at the time. The pollsters at that time had them staying in, continue being part of the European Union, and it was really interesting because after that period, people started going out and interviewing the citizens of Britain that voted to leave the European Union, and a lot of them were not quite sure what that meant. And that still continues a little bit today. They still need to iron out a lot of details as far as what that means. And so we'll talk through that a little bit more in depth as we continue on with what that means now and in the future for the Brexit, as they called it. So the other huge event that ended up occurring wasn't that the Chicago Cubs ended up winning the World Series, although it did feel like we're in an alternate reality when that occurred. And so being from Chicago, that's everything that I read on my whole Facebook feed for at least the month of the whole playoff series. So that was unexpected too. They came from behind, being down, I believe, 3-1, so they ended up mounting a comeback. But really the event that kind of shocked things to the biggest level of last year was Trump defeating Hillary to win the presidency. That was a huge shock, and even that night that it was occurring, the markets ended up having to throw in a stop switch because the markets had started falling pretty quickly overnight through overnight trading. And so people woke up in the morning expecting that the market was going to look pretty ragged and ugly when they woke up following the election results. But actually the opposite ended up happening. People kind of settled in and tried working through what that means for the U.S. moving forward. And generally a lot of people thought that it may not be that bad after all. So not only did it end up performing fairly well that following day, but then you could see since then the market's taken off quite a bit. So even though the market as a whole ended up doing very well, this is going to be a chart, and I'll zoom in a little bit more. It's definitely more helpful for people on the webinar today compared to the people that were on the physical event, because it was a lot harder to see on the screen being projected up. But this one, the colors are holding true. You can kind of see that even though the overall market did well, there's still a couple of sectors that didn't have a great year that were a part of the S&P 500, and predominantly that's going to be the energy sector. It had various ups and downs throughout the year, but just because the markets do well, there's going to be certain areas that do better than others. And so always want to keep that in mind and keep that in check when you're evaluating investment options and portfolios. One of the biggest winners after the Trump election win was going to be small size companies. And so the reason for that is because a lot of people feel that with Trump being president, that he's going to be passing a lot of protective laws for companies here in the United States. And although there are a lot of large companies that may end up being hurt negatively if there ends up being a trade war, there's definitely a lot of benefits to smaller companies that predominantly receive their revenue producing from the United States more specifically. So that's the reason why smaller size companies tended to pop up a little bit more than some of the larger companies as a result of the presidential election. So although that happened to be the case, it's definitely really hard to predict and pinpoint a time when certain segments of companies, whether it's going to be kind of sectors or company specific, when they're going to take off and do their thing. And so that's just kind of what this whole comic is displaying. So he definitely it's shown that he was wanting to become president, but now that he is just kind of making a joke that he may not know what he was thinking about trying to become president in the first place, because obviously it's a high-stress job. There's going to be lots of things that he's going to deal with that he's never had to deal with in the past, and some of the potential policies that could shape which companies and which sectors are going to be impacted are going to be these kind of key highlights, whether it be tax cuts. Definitely that seems to be the consensus, that there's going to be some business tax cuts coming sooner rather than later, and that could even spill over into individual taxes, which would be helpful for our clients there. There could be the possibility of corporate tax repatriation, which just means that there will be some tax breaks for people that, for companies that had moved portions of their company overseas, that if they bring those back, there may be some kind of pain relief compared to what some of the laws are now to be able to do that and to incentivize them bring in more production back into the United States. There could be some more infrastructure spending throughout the next 4 years. Tariffs on imports, we'll definitely dig into that a little bit more as far as potential impacts, but basically that's going to be charging other countries to ship goods into the United States. And all the global trade agreements, there's a couple that they've talked about pretty predominantly. Those are going to be reviewed, but there's also smaller ones that they're going to continue to evaluate, make sure that those make sense moving forward. And I think the biggest thing, and this kind of even bleeds into the financial advising industry a little bit more, and if time permits, I'll definitely try to delve into this a little bit at the end of the presentation, but repealing regulation, what that means is that there's going to be a lot less rules enforced, maybe even removing some of the rules that have currently been in place. A lot of industries that are expected to be impacted is going to be energy, and then as well as financials. So here is a look at not only what the U.S. stock market valuation has kind of moved through, and this is kind of looking at the price to earnings ratio, looking at 12-month trailing. And what that means is whether or not it's just another evaluation and calculation that people run to try to see whether the market may potentially be overvalued or undervalued. And you can kind of see throughout the various years that that's bounced around quite a bit. And it's a little bit lighter probably on your end, but there's the 5-year average, which is the dotted green lines, then the 10-year average. So typically it's going to be somewhere in the middle, but that's not to say that they can't stay high for quite a while. It doesn't necessarily mean that companies, or all companies for that matter, are overpriced. There's going to be different opportunities for various size companies and various industries that may provide attractive values and worth investing in. And although the U.S. has been doing fairly strong over the last handful of years since the recession, here's a kind of look at how we compare to some of those other stock markets around the world that are definitely well below their peaks, and they're doing it from this kind of point of view, from worst to best, and us being the best currently at the bottom. The Dow Industrials is what they're targeting. But if you kind of look at how Japan has fared, they haven't had a new all-time high since December of 1989, and even from that high back then, they're still 51% below that. So that's a huge, astonishing number. Hopefully that's not a situation we ever find ourselves in here in the United States, where something like that could last for as long as it has. There's just a lot of fundamentally things that they have to figure out, and structural things as far as business growth and those types of things, because they have an aging population that's not really supporting their economy currently. So that's one of the reasons for that. And as you kind of look through, that seems to be the case for a lot of other countries. It's just not as severe, where it's almost 30 years basically at this point for Japan that they've been behind that all-time high. So definitely had to feel good about our investments, and predominantly a majority of our clients, we tend to focus in US dollar-based investments, which have done well. And so we tend to hedge towards being more that more equity exposure here in the United States. We're still going to have exposure to international, but it's typically going to be a smaller portion of investments because those other markets just tend to be a lot more risky. They don't have the infrastructure in place to try to help in situations like we have with the Fed, where we're able to kind of do some financial stimulus to help the markets. And so speaking of dollar-denominated investments, you can kind of see the pros and cons of the strong dollar. And this is the chart here in the middle is showing exactly what happened November 9th. So the day after Trump ended up winning the election, you'd see that the Mexican peso fell substantially, as well as some other countries' currencies. And what that means is that in the United States, you'll definitely see that U.S. consumers are going to have a greater purchasing power. So if there's any imported items that people are purchasing, things that have been shipped from various countries, typically it's not going to cost as much to be able to purchase those as it would for some of those countries trying to purchase the United States products. One problem that could cause, though, is going to be some growth issues from U.S.-based companies that export a lot of goods, because our goods are going to cost a lot more to those other countries, and that could negatively affect economic growth in the future. And so vice versa, looking over at the overseas and how they see the strong dollar, their goods are going to be less expensive when they're exporting those, so there could drive some economic growth from that. It's going to relieve some of their deflationary pressures as well, which has been a huge concern, especially in Japan, as we mentioned in the previous slide. And debt denominated in US dollars ends up costing people more money to pay those off, because it takes more of their currency to pay off that same flat dollar amount that it was just before that November 9th time period. And what that ends up meaning is there's a lot of companies that have borrowed from the United States, and so what they're going to be trying to do is aggressively try to pay down those debts because it's really expensive for them when our dollar is strong. And that could cause global growth to be tightened a little bit, because instead of spending money for infrastructure, they're spending money on trying to pay down their debts a little bit faster than they would have should the currency be more stable and even across the board. And so it seems like Josh had been talking about this for a while, well before I ever joined Keystone Financial, but we thought at some point the feds were going to have to hike up interest rates, and it took years and years past what we would have ever expected, but they finally did it at the end of December 2015, and then again they did it at the end of 2016. So this comic is pretty funny to me. So they said it felt like it would take forever to get here, and the girl questions, "Are you talking about Christmas?" And my wife, who I believe was watching for a little bit of this webinar, she would have appreciated that, because that's her favorite holiday, and she always wants us to start watching Christmas movies as soon as possible, and that's what she always has on her mind. So that's why it's funny to me, and then that would be me right next to her, actually thinking more economically and thinking about finances and things like that. I'd be thinking about the Fed rate hike. So that's why that comic makes me laugh in particular. So the next major area that people want to keep an eye on is just kind of the bond market in general. So what we're viewing here is going to be the 10-year Treasury constant maturity rate. And you would think that as interest rates go up, that's actually good for bond holdings. It actually works in the opposite direction. So as bond interest rates go up, the value of your bond portfolio actually goes down. And the reason for that is because people are going to be holding on to something. So just imagine you went out and bought a new pair of shoes today, and then all of a sudden tomorrow they end up being a better sneaker that's 10 times better than what you bought, but they're trying to charge the same price. Obviously, you can't sell that back to someone and get the same price because there's a lot more value for something now that didn't exist the day before or month before. And that's kind of how you want to think about it with bond markets, that you're kind of purchasing something right now with kind of its own traits and values, but when something comes out better, it devalues what that is that you're holding, and that's how that works with the stock market or with the bond markets. So in bear markets, which means that the interest rates are rising, then the bond prices that you're holding currently would be falling. And in a bull market, bonds, the interest rates fall and bond prices rise. So if you look at this, you can kind of see that there's a pretty significant period that hasn't occurred in quite a while where there was a bear market in bonds with the interest rates rising. And kind of since the 90s, the start of the 90s, it's been a bull market in bonds because the interest rates have just precipitously been falling all the way through the most recent the Fed enacting the interest rate hikes at the end of 2016. And then also with Trump becoming elected, that ended up playing pretty wild with the bond markets as well, because a lot of people started leaving the bond markets, which reduced the demand for the bonds. And so that had the values of those bonds falling as well. So definitely a tricky situation moving forward for anyone that wants to be a little bit more bond heavy in their portfolios, because just from this dynamic here, it's a lot more risky essentially to hold bonds than they ever had been in the last 30 years or so. And this does a good job kind of presenting what the comparison is between an equity using the S&P 500 as a model for that and 10-year Treasury notes. So between 1946 and 1981, which going back to that previous slide, that was a bear market for bonds because interest rates were going up. So it's this left side of the graph there. That's what it's talking about on this left side. The value of your $10,000 investment over that, it's about 35-year period, was very minimal compared to that of the overall S&P 500. And then you kind of look at it since then, when there's been a bull market for bonds with interest rates going down. There's actually a lot more value that people were obtaining from holding bonds while interest rates were going down when you kind of compare that to the S&P 500. So it's a good visual to kind of see how that could look potentially if bond rates start to rise and start to look similar to that 1946 to 1981 time range. So if you guys remember from our outlook last year, there was quite a few countries that were operating with negative interest rates. So those things are now coming to an end. There's not too many countries now still continuing to do that type of incentive for trying to grow their economy. Here's a look at the different financial markets performance as of the end of the year. So you can see that the U.S. stock market definitely performed fairly strongly. International stocks not so much. I think that the biggest thing here is, so most people who were able to be as aggressive as possible with their investments definitely saw closer to that 9.5% range. Anyone who had a more diversified portfolio, where we are going to have international exposure in there as well as some bond exposure, definitely because it's diversified out, you may not have seen that full 9.5% clip. And the reason for that is just a diversification. For the same reason that we wouldn't want to go invest 100% now into Japan just because it looks depressed. Well, it could stay depressed for a very long time, and it could skyrocket. But really, we want to focus on areas that we could provide as much value for our clients and reduce their risk along the ways. And I think a lot of you guys have been coming in recently for our meetings, and what we try to do is target that rate of return that you actually need. And then we kind of back down the risk from there and make sure that everything matches up so that you guys are hitting your overall objectives. So generally, 2016 ended on a generally positive note. If you kind of look at the various data points that the Fed has been reviewing and that people who manage portfolios tend to look at, job rates have definitely been a lot stronger. Labor markets are starting to kind of increase salary and income as a result. So I'm sure a lot of you guys have heard of this, but this is a clip of the 1938 Orson Welles radio drama, War of the Worlds. And so essentially after that played on the radios, and I think I just finally listened to it for the first time this year. I've read a lot about it, heard a lot about it through either movies or just kind of news articles, but listening to it, it's definitely interesting that they paint a pretty bleak picture. It's kind of an alien invasion. So if you guys haven't heard it before, I definitely recommend you kind of look into that and listen to it. But this is kind of a highlights of where I'm going to get to next, where fake news isn't something that's new for 2016. There's been things in the past where there had been fake news, and so even after this radio air and played, there really wasn't any concern. No one was panicking or any of that. But it was interesting because the radio market and the kind of print advertisements and newspapers were in battle for kind of viewers and subscriptions and things like that. And so what the newspaper ended up saying is that it terrified the nation, which was far from the truth. And they were just kind of using that as a kind of weapon to try to get people to not trust the radio or listen to the radio. So this is where we are currently. Looking at the economic growth, it's better than it has been, but it's definitely not shooting the lights out. And one thing that I want to put into a little bit of perspective is you can see that kind of in the 2000s, early 2000s essentially, it was near about 4% real GDP growth for the world. And one of the things that a lot of people fail to kind of realize and look at is during that time period, there was a lot of debt being raised. People were borrowing a lot of money, leveraging themselves, a lot of companies leveraging themselves to kind of fuel some of that GDP growth. And so realistically, with where the economic outlook's now at about 2% for the world, that's pretty much aligned with what a real life expectation would be, with how much people have not been borrowing as much, with the exception of China potentially. So lots of people across the world have been reducing their debt limits, not borrowing nearly as much as they were in the early 2000s. And so in a lot of ways, from not using as much leverage, that's a pretty solid growth rate, being 2% compared to the 4% when the world was really heavy in kind of leveraging their investments and trying to grow companies from that aspect. If you look at this, this is going to be breaking out that global contributions to the GDP by some big market players in the country, in the world. And really you can see that Russia has been non-existent over the course of 2016, and it actually was a negative factor for 2015. And so that's one of the things that definitely stands out here. Everything else is pretty much status quo over the last handful of years. It hasn't been too many major increases or decreases by any particular company or country. And again, this is going to be comparing not only the growth aspects, but also weighing that compared to unemployment and inflation. So right now with the U.S., the Fed is targeting about a 2.5% inflation rate. That's kind of what their preferred inflation rate would be for the country if they could just snap their fingers and make that happen. And right now we're kind of clipping along at about 1.5%, so not quite there. But if you look at some of these other countries, Brazil has had some massive inflation. Looking at, let's see, it's just north of 8% inflation. So what that means is it's costing them 8% more to do their normal daily life, basically. And so that could have a lot of issues. definitely appreciative that we live here in the United States, where it's relatively easy for planning purposes as far as financial planning and things of that nature, because we're not too worried that all of a sudden tomorrow going to McDonald's is going to cost $15 rather than $5 to go eat lunch. So if those things were current here in the United States, where it was really hard to control inflation and inflation was out of control, that would definitely make it a little bit more scarier. I could tell you that investments wouldn't be performing nearly as strongly as they were, just because that would cause a lot of fear for people as far as how much money should they be spending, how much should they be saving. And so one interesting thing, so even though the economies have been growing fairly constant across the board, emerging Asia has now surpassed the European Union as far as growth goes. And that was even before the Brexit happened over the course of the summer in 2016. And so debt-ridden China. So this was the one country that definitely has been ramping up their debt pretty substantially, and it's doubled over the past decade. And so one of the issues with that is if they keep borrowing as excessively as they are, and their economy doesn't grow appropriately enough with all those investments that they're making, that it could cause actually a major slowdown. Right now, though, China is very strictly kind of guided as far as the finances and economics of how that country operates. So they do have a pretty good stronghold in right now on being able to try to stabilize the economy as best as they can, but that may only be a matter of time as the years continue to kind of increase that debt load that they're carrying. So refugees in Europe. So that's been a hot topic over 2016 and 2015. So far, there hasn't been any noticeable effects from the refugee surge into the European Union. But most people expect that this will start to have a very moderate kind of increase in the future, especially in the main countries kind of targeting right now for those refugees is Germany, Sweden, and Austria. So again, the referendum was passed back in the summer of 2016, and everyone kind of held their breath because no one knew what it meant. No one really thought it was a possibility. So other than probably the government people that were supporting that aspect really thought too much about it. And again, there was just a lot of people, just normal citizens that did actually vote for the Brexit that didn't know what that meant. They're like, oh yeah, like I think that just means that we get more independence, and yeah, they're definitely right about that, but they didn't know any of the details or that it was going to be as messy as it's going to be. So there's lots of things that still need to be resolved. Surprisingly, England has been weathering it a lot better than most people had expected at this point, but there's definitely likely to be some growth stalling in England just due to the fact of some of these dynamics shifting. It's going to impact some of their growth opportunities moving forward until they get everything situated and they're able to then ramp up from that point. So again, moving forward, negative yields are definitely going to be a thing of the past unless we end up running into another situation where there's just global growth issues that continue to be persistent. Really, even those negative maturities that they had presented out in Switzerland and other countries haven't really shown that much of a positive impact on kind of impacting the growth. So it's definitely been an area that people have been discussing and comparing and contrasting the benefits and the negative side effects of that. And they're slowly starting to fade out where there's not going to be any negative government bond yields moving forward. So definitely those two areas where we've been, where we are, and where we may be going. We'll be getting to the where we may be going part, but before we dig into that, definitely want to have you guys kind of reflect on what occurred for you in 2016. I know It was a big year for us as a company here at Keystone, as well as each one of us individually had a lot of personal things going on that were positive. And so kind of think back on 2016, reflect on your life, some of the good accomplishments that you've made, even some of those failures. Failures tend to be one of the best things that someone can learn from and truly take that next step in growth moving forward. Perfect. So hopefully all of you guys thinking about that had something very strong and positive to kind of reflect on. And now, before we dive in to moving forward, kind of envision how you want 2017 to occur. I'm sure a lot of you already have key moments. We have a few clients retiring throughout 2017. We have grandchildren being born. I'll be having a baby in just under 2 months now, so I'm super excited about that. But everyone has things that they're looking forward to, whether it's years down the road or this year, and there's just definitely get excited about those things, and we'll start moving on as far as financial markets and things like that, how those could potentially be impacted. So looking at the global outlook again for the gross domestic product, this is looking at the growth rates for the next 10 years, and they're kind of color coordinated, and I'm again going to zoom in on that so it's easier for people to kind of see those shades as well as see the countries. And basically it's looking like it's to be the same status quo as how the growth rates have been the previous 3 to 4 years, and so no major kind of shocks as far as what expectations are on that end. But it is good to know kind of which areas may potentially be growing faster than others, because those may present some opportunities. So a lot of different professionals that kind of look at forecasts and try to compare how things are going to be looking. This is one from Morgan Stanley, where they're saying that the global economy listed these past few years looks ready to rise, stretch, and get a move on again. This new momentum could push global economic growth to 3.4% in 2017, compared with an estimate of 3%, which was for 2016. So what this analyst is thinking is that we're going to build on that momentum that started occurring in 2016. If you remember 2015, it was pretty much a flat year. Nothing really good or bad came of 2015. It was just a non-story now at this point. But 2016, there was a lot of positive steps that had been taken. And so this analyst believes that moving forward, we may be able to kind of use that as a footing to continue to grow that momentum moving forward. And so this is looking at another economic outlook from the conference board. And so they're saying that it could potentially be a slow growth year because there's so many different unknowns. There's still very small growth rates, not only here in the United States, but throughout the world. Another thing that could continue to be very popular moving forward is that populist movements. And so definitely most people would consider that Donald Trump being elected president was a populist movement. So a lot of people were not happy with the previous status quo situation, and so they kind of band together to put Donald Trump into the presidential office, and hoping that he'll kind of shake things up and change things from the status quo that had been the case for many years now. You can see that there's been other countries that have done a lot of similar things, whether it's the Dutch politician that was eliminated for his, or he wants to eliminate hate speeches actually. So it's kind of interesting that he'd kind of be taking that step. And then there's a Spanish party that wants to give immigrants voting rights. I'm not too familiar with the dynamics of Spain and as far as how many immigrants are there, but if it's anything like the United States, there's definitely a reason to allow some of those people to vote. And so a lot of people are building up momentum from trying to change the status quo across the board there, whether it's in the United States or any of these other countries. And I think one of the reasons for that would be a good indicator is the rise in technology. So a lot of these companies are being brought up to speed a lot more, so they're able to quickly and dynamically communicate and kind of form groups. So I think that's definitely something that's a lot of people to connect, which in the past wasn't as easy as it is now. So that's definitely kind of fueling that populist movement. And again, focusing here specifically on the U.S. populist vote, a lot of people expect that Trump is going to change things as far as trying to protect a lot of the U.S.-based workers that had either lost jobs or haven't received raises in the last handful of years. So that's definitely something that kind of helped motivate and kind of propel him to the presidency. And that was one of the popular points that he was standing on. And so a lot of people, though, are wondering how that is going to work. Is it going to allow stimulus into the country? And if that does happen to be the case and the stimulus actually catches and starts to rev up the economy, what would that mean? So here's a look at quite a few analysts that have forecasts, and all of these ones are kind of predicting positive growth rates just throughout. And if you kind of look back historically, there's always been a wider range of people being optimistic about growth opportunities than there are on the negative side. And so if you were to pick something up, as long as it's not a newspaper directly that's just trying to get sales and try to get people fearful to read the next thing that they publish a month later, these particular people tend to provide and be more optimistic with market opportunities and outlooks. And it's really interesting because looking back 2016, a lot of people end up feeling more positive as the market gets, as the investment market tends to grow and kind of get some legs underneath it. And to me, that's always interesting because really what that means is that now that things are more expensive, they're saying that it's worth investing more money. So if you're able to come up with cash, that it may make sense to kind of reallocate that and invest it in the market now, when really there hasn't been crucial changes that occurred over 2016 that would have changed the fundamentals that much. We already knew that the job market was getting better and that the Fed's going to start increasing rates and things like that. So it's always interesting to see how people kind of move along with what the general populist opinion is. So, and this guy here thinks that there is, because of the strong market valuations, and we reviewed the PE ratios earlier in the presentation, but he's saying that definitely there's an argument where there could be some cap on the upside just due to the pricing procedures right now. So really what that means is that companies would have to surprise with their growth rates moving forward for 2017 and outperform in order to get that needle to move in a substantial direction positive. And so here's Randy Frederick. He's saying that the thing that he's most worried about is that it seems that no one's worried about anything right now. And that's also not the case, although a lot of people tend to get more feel more optimism when the markets are doing well. There's still a lot of people that have always been on that downside of the thing, just saying that really that's things, they kind of focus on all the negative issues. And so there's always still about the same amount of people feeling negatively as there is positively. This is a kind of a quick snapshot of the total bond market, whether you're looking at global rates or the US-based rates. And virtually all of those just kind of indicate that they started eking up a little bit towards the end of 2016, essentially, which could mean that it's going to have a negative effect on bond portfolios. So consumer confidence, that's something that is always widely promoted and advertised whenever they get the most recent studies back for that. That has also has been building up over the last year, basically, and you can see, looking through 2015, it wasn't until the very end of 2015 where it kind of made any types of movements, and it was actually in a negative way. And so here, again, is really one of those interesting factors where if you kind of look at this, this is looking from the end of 2015 to the end of 2016. And really where a lot of people felt the most strongly about investing was at the end of the year, now that things have ran up quite a bit. So one of the things to keep in mind is, although kind of most forecasts right now are predicting a pretty strong performance of the market, kind of targeting that 10% range, that doesn't mean that you guys should shift from what you've done in the past or try to do anything that will be too risky, because really the thing that I encourage all of our clients to think about, and anyone who's listening to this webinar, is to make sure that you're not making any sudden movements or any emotional decisions based on what the market's doing. Typically the best way to react, if you're feeling like you want to find other ways to invest money or raise cash to invest money, the things that you want to ask yourself is, what has changed since the beginning of the year? So the beginning of the year, the market looked horrible, and so people weren't feeling all that confident about it. But realistically, now the market's a lot more expensive. So what, besides the pricing of the market and seeing the market bounce around, has changed for you? So that's one good thing to ask yourself before making any huge decision. The next thing is your risk tolerance changed? Because obviously it's a lot riskier now to invest with those price to earnings ratio being higher than they were earlier in the year. And those are going to be the key things, as well as any types of timelines. If your timeline shifted, has your goals shifted, and if all those things say no, nothing's really changed, then why would you end up taking a lot more risk for something that you weren't willing to take the risk with those particular funds or assets at the beginning of 2016 when things weren't looking so good? So although we want people to feel optimistic about their current investments and not necessarily make any changes, for this particular timeline, and I've heard a lot of clients ask me, well, the market's doing really well, should we shift and try to move things around to become more aggressive? And I just say, well, if it didn't make sense a year ago, things are a lot more riskier to do something like that, so it wouldn't make sense now. So by asking yourself those questions, you'll kind of self-validate that, but always we're here to answer any questions that may come up. So as always, we're going to quote Sir John Templeton, which is a great contrarian investor of his own time, and he said that bull markets are born on pessimism, grown on skepticism, mature on optimism, and die on euphoria. The time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell. And so definitely kind of what I was trying to paint in the slide before, in the those few bullet points that I was hinting at, that we definitely have all of our clients diversified in a way where they should feel confident regardless of what the markets are going to do at any short-term time period, whether it's a year or 2 years, because most of our clients have a really long time horizon. So with that diversification, it wouldn't call for any huge major moves unless any of those three things have changed, that your risk tolerance has changed, your goals have changed, and those types of things. So no matter your point of view or what you've been reading or hearing, we're always going to be here to help you and your friends and family pursue their financial goals. And I will get to the next slide, because again, this is going to be the most important thing to me, Josh, and all of Keystone, is that what's new for you guys. We enjoy going through the numbers. We enjoy reviewing the possible changes that could arise through the Trump election, whether it's affecting tax rates and trying to find out how we can best strategize to help our clients in that situation. But really what it comes down to is we truly do work with our clients on an individual level, knowing what they're doing, whether there's marriages for grandchildren, children, any major life changes. We truly value the relationship we have and getting to know you guys. So if there's anything that's on the horizon that you guys would like to share with us, definitely shoot us an email or schedule a time. We can schedule a time to meet up for coffee, or for you to visit the new office space and we can give you a tour. So all of those things are really what excites us. Obviously, we don't get bored by finances and things like that, but really it's the relationship we have with our clients that make our job worth doing. And here's our team, and just reminding you that our team's not only here for you, but any friends and family that may have questions for us. So don't feel ever like you have to filter. And for us, the only thing that we ask you to filter is we want you to send us nice people, great people that are just like you, basically. So that's That's the only filter you guys need to do for us, and we'll always meet with people free of charge and make sure that we give them a true, honest analysis of what we think we could help with, and if it makes sense that we're not going to be able to help too much past that first meeting, we would be honest with it, we'd be nice about it, and we'd make sure that they did obtain value in meeting with us. And again, just let us know if there's anything changing for you that would require some planning, or if you just want to meet up to catch up with us. We know that it's been a busy year as far as paperwork and some transition things, but it's definitely important for us to keep connected with each and every one of you. The last thing I'm going to just plug a little bit here is we had our first Coffee with Keystone. That was about 2 weeks ago now, and that was a really fun event. We are going to have another one, I believe, at the end of March, so be on the lookout for that invitation. And what Coffee with Keystone is, if you haven't read the previous description for that first one that we sent out, it's just a nice way for you to come in and just ask us anything, basically, that's been on your mind. And it's very informal. We kind of come, we'll have coffee, we'll have donuts, and we try to do it before most people would have to get to work. So if you guys are still working, we try to make it convenient for that. And you can pop in for a half an hour, 45 minutes. We schedule it for an hour, but this last time people stayed, and it was perfect because we were able to answer a lot of questions, especially in regards to transition and things like that. So if there's any questions that you guys have, we're always excited to make sure that you feel like you're getting the answers that you need to kind of have confidence and have that feeling of knowing what's going on here at Keystone as well. So I'd invite you to be on the lookout for that, and it's also another opportunity for you to invite people that may have been interested in the past and just haven't connected with them, because it's really informal. We're not going to pin anyone down and make sure that they commit to anything before leaving. It's just truly to have a conversation with us. And if coffee and come in early in the morning is not your thing, we are going to kind of change it up throughout the year. We're going to continue doing events like that, but we may have wine and cheese, or we may have margaritas or something. We're definitely open to any suggestions that you guys have. But yeah, we'll try to make it fun and light and easy to kind of come through and make sure that we answer any things that could be on your mind at the time. So with that, definitely shoot over any questions that you guys have. I'd be happy to answer those for you. Definitely been fun going over the webinar portion with you. I'm glad that we're have this technology working where those of you who work are unable to make that morning time frame are able to join us. So I'll give you guys a couple minutes to ask any questions, and I'll make sure that we get those answered.